Are you making these common mistakes while investing? Let's face it, we all make mistakes. We're only human after all. But when it comes to investing, certain missteps could result in substantial financial consequences. That's why we're here today, to illuminate those common pitfalls that catch many investors off guard. Investing is a journey, filled with obstacles and opportunities alike. Navigating this path effectively requires a clear understanding of not just the rewards, but also the risks and potential mistakes that one might encounter. Many of us plunge headfirst into the world of investing with an aim to grow our wealth. But without a clear roadmap, we could easily find ourselves lost in a maze of investment options. This brings us to our first common mistake, not having a clear investment goal. While it might seem like a no-brainer, you'd be surprised at how many investors overlook this crucial step. Next on our list is the blunder of ignoring risk management. It's easy to get caught up in the thrill of potential gains, but without a proper risk management strategy in place, you could be setting yourself up for financial disaster. Ever heard a hot tip from a friend and rushed to invest only to be burned later? That's our third common mistake, chasing hot tips. Investing based on hearsay and rumors can often lead to disappointment. Diversification is a term you might have heard often, but not everyone understands its importance. Putting all your eggs in one basket is the fourth common mistake we'll be discussing. Lastly, we have the mistake of not reviewing your portfolio regularly. The world of finance is dynamic and ever-changing, so it's essential to stay updated and make adjustments as necessary. These are just a few of the common mistakes that investors often make. But fear not, for each of these pitfalls comes with a solution. Stay tuned as we delve into each of these mistakes in detail. The first mistake many investors make is not having a clear investment goal. Just imagine a sailor setting off on a voyage without a destination. Sounds absurd, right? Well, that's exactly what you're doing if you invest without a clear goal. An investment goal could be anything from buying a house, to funding your child's education, to planning for retirement. It's the why behind your decision to invest. Without this compass, you can easily lose your way in the vast ocean of investment opportunities, often resulting in unnecessary losses. Let's take the case of Mr. Sharma. He started investing without a goal and ended up with a portfolio that was a messy mix of random stocks and bonds. When the market dipped, he suffered heavy losses, and it took him years to recover. Remember, a clear goal is the compass that guides your investment journey. The second common mistake is ignoring risk management. Risk management is the process of identifying, assessing, and controlling threats to an investor's capital and earnings. These threats or risks could stem from a variety of sources, including financial uncertainty, legal liabilities, strategic management errors, accidents, and natural disasters. Now, imagine a deep-sea diver without an oxygen tank. Sounds risky, right? That's exactly what you're doing when you ignore risk management in your investments. Let's consider the case of John, an investor who put all his savings into one high-risk venture. When the venture failed, he was left with nothing. Had John considered risk management, he could have diversified his investments, limiting his exposure to any single risk. The lesson here? Don't dive into the investment ocean without your oxygen tank. Ignoring risk management is like ignoring the safety measures in any endeavor. Remember, risk management isn't an option, it's a necessity. Third on our list is the mistake of chasing hot tips. You know the type, the whispered stock advice from a friend of a friend, the late-night infomercials promising the next big thing, or the flashy online ads touting a surefire investment. But here's the reality. If it sounds too good to be true, it probably is. Take the case of Rajiv, an enthusiastic investor who put a significant portion of his savings into a hot tip. He was promised sky-high returns, but instead, he saw his investment plummet. Why? Because these tips often come from unreliable sources, or they're based on short-term trends that can turn on a dime. Investing isn't about quick wins, it's a long game. It requires careful research, understanding the market, and making informed decisions. Relying on hot tips is like gambling, and the risk is often greater than the potential reward. Hot tips are often not as hot as they seem. The fourth mistake is not diversifying your investment. Diversification in its simplest sense is the practice of spreading your investments across different types of assets, industries, and geographical locations. Think of it as not putting all your eggs in one basket. It's a powerful strategy that can help manage risk and reduce the volatility of an investment portfolio over time. To illustrate the importance of diversification, let's consider a hypothetical situation. Suppose you invested all your money in a single tech company. Now, if that company takes a hit, your entire investment is at risk. However, if you had diversified your portfolio by investing in different sectors like healthcare, finance, and retail, the loss from the tech company would have been cushioned by the performance of your other investments. Remember, diversification is not just about spreading the risk, it's also about creating opportunities for growth. Different assets perform well under different market conditions, so a diversified portfolio can help maximize returns over the long run. Diversification is not just about spreading risk, it's also about maximizing returns. The fifth and final mistake is not reviewing your portfolio regularly. Now you may wonder, why is this so important? Well, just as a ship's captain needs to regularly check his course to ensure he's on track, so too must an investor keep an eye on their portfolio. This means not just casually glancing over it, but conducting a thorough review, assessing performance, and making necessary adjustments. Allow me to share a cautionary tale. There was an investor named Ravi who set up a diverse portfolio and then left it unchecked for years. He assumed his investments were doing well, but when he finally reviewed it, he was shocked to find that several of his stocks had plummeted and his portfolio was in a poor state. Had Ravi reviewed his portfolio regularly, he could have identified these underperforming assets and made timely changes. Regular portfolio reviews keep your investments on track. Now that we've outlined these common mistakes, let's discuss how to avoid them. In the world of investing, the path to success is often littered with pitfalls. These mistakes can be costly, but they can also provide valuable lessons. Let's take a moment to recap the common mistakes we've discussed and share some practical tips on how to sidestep them. First, we talked about the importance of having a clear investment goal. Without a defined goal, you're like a ship without a compass, drifting aimlessly in the ocean of investment opportunities. To avoid this mistake, take time to identify your financial objectives. Are you saving for retirement, a new house, or your child's education? Knowing your destination will help you choose the right investment vehicle and stay on course. Next, we underlined the danger of ignoring risk management. Investing without considering risk is like driving blindfolded. You might get lucky for a while, but eventually, you're likely to crash. To avoid this, always assess the potential risks before investing. Diversify your portfolio, use stop-loss orders, and never invest more than you can afford to lose. Then, we discussed the folly of chasing hot tips. While it can be tempting to jump on the latest investment trend, remember that not all that glitters is gold. To stay clear of this pitfall, do your own research. Verify the credibility of the source and the validity of the information. Don't let the fear of missing out cloud your judgment. We also touched on the error of not diversifying. Putting all your eggs in one basket is a risky strategy that can lead to significant losses. To dodge this mistake, distribute your investments across different asset classes. This way, if one investment performs poorly, others may perform well and offset the loss. Finally, we highlighted the oversight of not reviewing your portfolio regularly. Investing is not a set-it-and-forget-it activity. Just as a gardener regularly checks and prunes their plants, you need to monitor and adjust your portfolio as necessary. To escape this blunder, schedule regular portfolio reviews, keep an eye on market trends, and don't hesitate to rebalance your portfolio when needed. Avoiding these mistakes can make your investment journey smoother and more profitable. It's like navigating a treacherous mountain path. If you're aware of the common pitfalls and have a map to guide you, you're more likely to reach your destination successfully. But remember, the best investor is an informed investor. So, keep learning, stay vigilant, and don't be afraid to seek professional advice. The world of investing can be complex, but with the right knowledge and approach, you can navigate it successfully. Avoiding these mistakes can make your investment journey smoother and more profitable. Remember, the best investor is an informed investor.